Rushanara.
Thank you, Chair. Governor, you seem to be getting it in the neck lately from Conservative politicians in particular because of inflation. Liam Fox, some members of this committee, and I'm sure it will continue. And it does seem like a bit of a coordinated attack on the bank, in my view. How do you feel about that? And do you think the independence of the bank is at risk?
Well, I don't live in the I don't live in the world of anybody's politics, actually. So I'm afraid it's not a world that I particularly respond to at all. Actually, I read about it, but I don't respond to it.
You have read about it.
Sorry?
You have read about it.
I've read about it. Yes, I do read newspapers.
And so much. I mean, just going
well,
into the more
substantive
point about independence.
Yeah, no, that is.
Cabinet ministers are reported to have had to come in and reaffirm the independence of the bank in light of some of these criticisms. Are you concerned that there is this chipping away of the bank's legitimacy in the current context?
Well, I'm always concerned about ensuring that the bank's independence is preserved and is understood. I have to say that this is the biggest test of the monetary policy framework that we've had in its 25 years. No question about that. What I would say to these people is, this is when both the independence of the bank and the target framework and the nominal anchor matter more than ever. Frankly, I mean, more than in the good times, as it were, the easy times. This is the point at which it is, and people often talk about the 1970s and what's the difference with the 1970s. Well, the big difference with the 1970s is that we didn't have an anchor. We didn't have a nominal anchor in the 1970s. We didn't have a monetary policy anchor, and what you got in the 1970s was a high rate of inflation that persisted across the whole decade.
Does anyone else want to come in on this particular point about independence and some of the criticisms that we've heard about in the press towards the bank?
I mean, yeah, go ahead.
Merely to agree with what Andrew's just said, that the importance of independence and the importance of the target are even greater in times of maximum stress.
And I think all I would add, and it comes back to...
They need to call off the dogs, do they? The people who are attacking.
No, all I would add is that the discussions today are critical to that legitimacy, because it not only do we have an independent MPC, but a central part of the reforms that were done in 1997 and subsequently consistently applied were transparency and accountability. So we try and put as much information as we can out there, including, for example, that forecast comparison I gave you, and then you hold us to account for it, through discussions like this and wider debates in Parliament and throughout society. And it's that accountability, I think, is a central underpinning, whether Parliament or through our efforts with the public, to sustaining the position that we're in.
So I've got my next question's about wages, and as the chair mentioned, that obviously wage pressures on inflation has been referred to in the past. There was a particular policy decision that the government made about city bonuses, and which is the subject of an article reporting to the IFS's study. That says that the return of bumper finance industry payouts means that the top 1% highest paid workers were beginning to pull away further from the rest of the UK workforce, despite the cost of living crisis hitting the country at large. So, that's not a decision the bank made. That was a government policy decision. So when there is a discussion about wage pressures, inflationary pressures and demands for increasing wages, which is understandable if you've had wage freezes for a decade, and there's a decision in parallel that a government makes to allow for city bonuses. What do you say to that? Are there inconsistencies in the way we talk about wage pressures?
Well, two things.
I know you ran into hot water when we last talked about wage pressure, but is there some rampant hypocrisy here in people attacking in central banks like yours, while failing to act to bear down on wage pressure that is a direct consequence of government policy?
I'm not quite sure which government decision is referring to, I mean, what the government hasn't, I mean, obviously when we onshored the EU financial services legislation, we inherited the bonus cap. And nothing, the bonus cap is still with us. I mean, nothing's changed. Obviously, that's with the government. It could be changed, but it's not been, and I'm not aware of any move at the moment to do so. So that hasn't changed. So I'm not quite aware of what government policy that is. I mean, let me say on the second part of your conversation, I mean, my view, and I was asked about this in an interview the other day, is I do think people, who, particularly people who are on higher earnings, and people, should, think and reflect on asking for high wage increases as a matter of, it's a societal question. I'm not preaching about this. I was asked if I'd, taken a pay rise myself this year, and I said no. I'd asked the court of the bank not to give me one because I felt that was the right thing for me personally. But everybody must make their own judgment on that. It's not for me to go around telling people what to do. In that sense, I know I may have been interpreted as doing that at the time, but I wasn't saying that. What I was saying is I think people should reflect on it, particularly people in that situation.
Just turning to the question of where the labour market pressures, Adam Posen talked about the impact on the UK is going to be the sustained impact. Argues that inflation is likely to be more sustained in the UK than in the European Union because of its labour market being tighter due to lower levels of immigration into the UK from leaving the European Union. Do you agree?
Well, I think the point Adam was making was that if the UK becomes a more closed market post-Brexit, then it becomes somewhat more inflexible. I think the challenge at the moment in judging that is, and it sort of goes back to what we were saying earlier, that the biggest impact, first of all, the biggest impact so far in the labour market is appears to be COVID-related. We think there is a net migration number there as well, but it's a smaller number, we think. It's a hard number to calculate at the moment because the data are not very good. And secondly, it is very hard at the moment to separate the impact of COVID and the impact of Brexit in this area, because both of them have, I think, reduced the cross-border flow of people, of migration. And that's certainly what employers tell me when I talk to them. So I think in time we'll know the answer to that. But at the moment it is very hard to make that judgment because COVID is having the same effect.
So Dave, did you want to come in on labour shortage, or Jonathan Haskell?
I mean, the only thing it actually goes back to a point I was making earlier about my most recent visit to a set of businesses in North Wales, is that, again, you are seeing businesses adapt to the world that they're in. So you're seeing more and more examples of businesses having to do their own training in order to deal with, for example, skill shortages. To pick up on something that when I was last here we talked about, you particularly see it, for example, in the haulage sector. More and more HGV companies are now, as it were, growing their own, taking people from warehouses, developing their skills so that they can then over time take on the more, pass the qualifications and become HGV drivers. So you are seeing, again, the economy, the private sector, as it were, adapting, supported by policy, changes in regulations and stuff at the margin. So, but back to Andrew's central point, you really can't, with so much going on as the economy responds to a whole series of shocks and changes, Brexit, the pandemic, energy, the war in Ukraine, it's impossible to disentangle different effects and the interplay of different forces.
Jonathan and then Michael.
I just wanted, if I may, just to have a word about bonuses that you're asking about. I mean, you're quite right that they make a difference. So average wage index excluding bonuses year on year to February was 4.7%, including bonuses is 6.4%. Actually, it turns out that we don't measure all of the bonuses you might want to measure, like signing bonuses in that. So if you put those into a more comprehensive measure, you get 7.3%. But the point I was going to make is those bonuses have spread out a long way beyond financial services, actually. Whilst it's true that financial services in normal times account for the lion's share, they've spread out a long way beyond that. I believe there's a story in the Times today that EasyJet are offering a £1,000 bonus conditional upon various things to some of their crew. So I think it's not just the financial sector which is paying these bonuses, actually.
Michael, did you want to come
Yeah,
in?
Brexit has reduced the UK's potential output, and that's through adverse effects on business investment and hence productivity, and also on labour supply. And it may also have increased the extent to which, if there is excess demand in the economy, that inflation picks up, because the UK's labour and product markets are less open. But it's wrong to think that this will be a cause of persistently high inflation in the UK. The MPC has the tools in order to ensure that inflation returns to the target. And we've shown our willingness to act accordingly. So you could regard it as a factor affecting potential output, but not a reason for persistently high inflation.
I was making a point about wage pressures and labour, supply of labour. The earlier discussion about, in relation to the chair, about labour shortage and, well, your point about bonuses being offered. But in substance terms, obviously energy prices are the main drivers for inflation, according to your own report. But just trying to understand better where all these different pressures are coming from. So individually, they may not be the significant one, but they play a part, do they not?
Look, there's an issue of domestic capacity pressures across all sectors, really. That the recovery in the economy, welcome, has outpaced the economy's potential output. And as you see capacity pressures across all sectors, you see it in the labour market, you see it in capacity use in firms and in pay growth, not just at the top end, but it's a widespread pickup in pay growth, and in services in inflation. So monetary policy is really trying to ensure that domestic inflation pressures don't remain persistently high.
And what impact is there of a fall in sterling on inflation?
Because we import a lot of goods, a fall in sterling will put up the price of those goods. But back to Michael's central point, we although there's all these things going on in the economy, and it's an unusual period for that. Certainly when you compare it back to the kind of first 10 years that the MPC was created, it was called, one of Andrew's predecessors dubbed it the nice decade. It was also known as the Great Moderation globally, as China entered the global economic system. Nevertheless, we still, as a monetary policy committee, whatever's going on, including with the exchange rate, we have the tools to bring inflation back to the target in the medium term, and that's the critical thing. And when you look, and through the period of the 25 years that we've been in existence, we've seen lots of exchange rate moves, and the exchange rate has depreciated over time. But over that period, inflation has averaged 2%. Over the whole period, there's been quite a lot of volatility, particularly recently, but also for some of the earlier energy shocks. But inflation has averaged 2%, and we will deal with what happens with the exchange rate. We're an inflation targeter. We have to take account of the exchange rate, and we'll deal with it to ensure that we get inflation back to target in the medium term.
I'll just say, it's worth noting that although, of course, we measure it against a basket of currencies, the biggest depreciation has been against the dollar, but that's been true for many other currencies. And the reason is, I talked earlier about this trade-off situation we're in, growth going one way. The US is in a different place. The US has got a demand shock, effectively. Demand and inflation are going up. And that's why the Federal Reserve has actually given stronger messaging about its interest rate path, and indeed has raised by 0.5. And I think a lot of that relative change in interest rate expectations has influenced the movement in the exchange rate.